The next speaker is our property tax specialist, Graham Loosley, who's from Mercy and Accountants based in Shrewsbury. Graham has kindly come again. He's spoken at the last two conferences that we have. They have numerous landlord clients all over the country and portfolio clients as well. So Graham is an expert in sort of tax for landlords. He's always very welcome to come along and speak.
Hello, good evening. So, good evening, and it's tax. Quick introduction, I'm Graham, and I've been working as a tax accountant for nearly 40 years now, but it seems much longer, and I've recently taken up running, and I missed the marathon this time round because of sore knees, but I'm going to have a good crack at it again later this year. I'm a partner in Mercy and Accountants, and we are a local accounting firm. We specialise in tax planning, and we act for many property investor landlord clients. There's always a health warning. We're not allowed to advise, but I'm very happy to share information with you, and of course before making any decisions, please do seek proper advice from an advisor who knows your circumstances and can make sure things are done properly. And isn't it exciting talking about tax on a Wednesday evening? It's about 4 to 8. So Dawn's asked me to cover some topics for you, and given the time available, I'm going to go quite rapidly, but of course I'll be available afterwards, or indeed after this evening, if anybody has any further questions. And there's such a lot happening. We just have so much to deal with currently. And the Bank of England are telling us today we should all get used to being poorer, and that's not where I'd like to be at all. So this chap, his parting gift to all of us landlords was Section 24. Now when Section 24 was conceived, we were in a very benign low interest rate environment. We're now in a much higher interest rate environment, and it's biting really hard. And for those who don't know the details of this, we used to get to deduct our interest cost from our income before working out our profit, and instead of doing that, we now simply get a reduced tax credit. So it's effectively a tax increase for all landlords, and it's much worse when interest rates are higher. But you can use a company for that. Now, if you have a personal property portfolio, there are two main obstacles to getting from personal ownership to company ownership. One is capital gains tax, and the other is stamp duty land tax. And there are ways, if you know what you're doing and you have the right setup, to actually move from personal ownership to company ownership without triggering either of those taxes. Why would you want to do that? Well, by Section 24, companies are subject to Section 24, and interestingly, when landlords are thinking about reducing or selling up portfolios, we sometimes help landlords into a company first before making the sale, because capital gains tax is much higher for individuals. If I bought some properties 20 years ago, and hopefully they've increased in value over that time, if I sell personally, I'm paying 28% capital gains tax on quite a large gain. If instead, before selling, I incorporate my property business into a limited company, and the limited company disposes of the property, its gain is calculated from when the company acquired the property at market value. So companies can sell with much reduced capital gain cost. Now the gains, of course, don't disappear when we incorporate it. They have to go somewhere, and where they go is into the shares, in the share capital of that company, But so long as you don't sell or give away those shares, then the capital gain is never triggered. And should those shares be inherited later on, there is currently no capital gains tax payable on inheritance, although there is, of course, inheritance tax. So moving along, one of the headline bits of news this year, I can't believe they were going to do it. I can't believe they went through with it, but they've gone and done it. They've increased corporation tax, which is exactly what we don't need to do at a time when the economy is struggling. And the rate of corporation tax was 19% for a long time, and it's now 25% for many businesses. But the bit that many people haven't noticed, and perhaps haven't spoken to their accountant about, is what happens to the rate of corporation tax when you actually have more than one company. If you're having profits of around £50,000 and you have one company under your control, you'll still pay 19%. But in a situation where you control multiple companies and they have different levels of profitability, you can actually find yourself paying 24% tax on the same profits. And you're all thinking, well, 19% to 24%, it's only an extra 5%. But 5% on a tax rate of 19%, it's a 25% tax increase. So it's really important to get advice if you're in a situation where you control, perhaps with other family members, more than one limited company. Hands up who's heard of ATED? If anybody here this evening has a limited company that owns residential property, where the property is worth £500,000 or more, please speak to your accountant before Friday, because the annual tax on embedded dwellings is going to bite. This is a revaluation year, and providing the property is let out on commercial terms, you can simply file a return, as I've done for some clients present here this evening, and no tax is payable. But as with most things HMRC do nowadays, there is a really unpleasant penalties regime, and if you don't file the return, claim the relief, even though no tax may be payable, you'll still be paying penalties. Now, we're living in an era when many rates and reliefs have been frozen. I think my personal favourite here is the nil rate ban for inheritance tax, which was last increased in 2009, and it's 2023. So for 24 years, the amount that a family can inherit before 40% tax is paid has not increased. And in that time, house prices have moved just a bit, haven't they? And when we freeze tax rates, and we freeze allowances, and we freeze thresholds, that can lead to a phenomenon which we call fiscal drag. And fiscal drag means that although the tax rates haven't been increased in theory, we're actually all paying a lot more tax. This chart was put out and it shows quite clearly that the level of income that's required before you become a higher rate taxpayer is collapsing over time. Being a higher rate taxpayer some years ago used to mean you were doing really well. Nowadays, people in ordinary professions are 40% taxpayers and worse. So it's worth having a look at your tax arrangements to see what can be done. Now, making tax digital, one of my favourite topics, it's one of those things which just won't go away. We can't kill it. It gets kicked down the road, but it keeps coming back from the dead all the time. Now, at the moment, we are told we've got some more time before making tax digital is going to happen, depending upon the level of your income, and that's income and not profits. But at some point, this is going to come in, and it's going to mean a lot of change. We'll be filing quarterly tax returns effectively. You'll be using computer software to record your property business records, and it'll be a lot of extra work for you and your long-suffering accountants. So I would suggest we think about getting ready now. And the rather snappily entitled NTD for ITSA, Income Tax Self-Assessment, affects the self-employed, those in partnership, and of course us private landlords. And it's going to happen. It's been deferred twice now, but it's eventually going to come in, and it's worth getting ready for it now. But the thing that has not been deferred is the equally interesting basis periods. Hands up anybody here who makes up their accounts to a date that is not the tax year. Anybody have a year end for their accounts that isn't the tax year? Just a few of you actually. Okay, so I'll cover this. I had hoped to be able to skip past this part, but we'll do it. So basis periods is where we can work out the tax that's payable for a business where the year-end date is not the same as the tax year. And for a long time it was, we would use the accounts that ended in that tax year to work out that taxpayer's tax bill. So the accounting period is different to the tax year, didn't used to matter, but this is the transition year. So if you are self-employed, in partnership, a personal landlord, and you make your accounts up to a date other than to the tax year, you're already in the transition year. And this staggering of your year-end date and the tax year is getting dealt with this year. Overlap profits, I won't bore you with those, they're quite dense, but overlap profits are being dealt with and got rid of. And if this produces excessive tax costs, we accountants can apply to smooth that over the next 5 tax years. But if your year end is not the tax year, please speak to your accountant, or perhaps speak to an accountant who thought to mention this to you, because it's happening right now. Moving on to capital gains tax, there's quite a flurry of activity in the disposals market, because rather generously the government have just halved the threshold before we start to pay capital gains tax. Every individual used to have an annual exemption of £12,300, and hey presto, it's now £6,000. And the problem with capital gains tax is it's just an expensive tax. There are planning opportunities, especially around limited companies and using spouses, but it's just getting worse. And the theory is that the reliefs are going to be reduced again. Now, we've touched on HMOs. I've got a lot of clients investing in HMOs, chasing better yields. And there are some differences in the taxation of HMOs compared to longer term lets. There are conversion costs to think about, and there are some things we can claim for from a tax point of view with an HMO that we can't with a single let. There's a thing called capital allowances. Who's heard of capital allowances? Quite a few of you. In a tax case decided in 2019, the tribunal ruled you cannot claim allowances for equipment installed in communal areas, such as shared bathrooms, kitchens, and living rooms, but you can still claim for equipment installed in common areas, which is different to communal areas. And we're thinking about heating, lighting, cooling equipment, and there can be some quite substantial sums available, and this simply isn't possible for a single let property. And then of course, when you're doing the conversions and getting those fire doors installed with the surrounds and all the other things that have to be done to convert to an HMO, if you have planning permission and you have building regulations and you speak to the builder before he invoices you or before she invoices you, you only need to pay 5% VAT if you're creating additional dwellings. There are some very complicated VAT rules around property, but the concept is if you're creating additional dwellings, you can pay 5% VAT rather than 20%. But you must get this sorted out in advance. If you pay too much, there's no mechanism for claiming back the excess later. And we've been speaking about auctions this evening, and particularly the modern method. From a tax point of view, we care about how the sale happens, because for capital gains tax, we need to know when did the ownership pass as far as the taxman is concerned. And the rule is, it's when the buyer is committed absolutely to the purchase. And in traditional private treaty, that's exchange of contracts. In a traditional auction, it's fall of the hammer, and modern method, it's actually sometime after fall of the hammer. Now, although there is a very, very small fall-through rate on modern method of auctions, if you've actually paid your buyer's fee and then don't go through with the sale, you're getting no tax relief whatsoever on that buyer's fee. It doesn't go anywhere. There's no relief against income, there's no relief against capital gain, it's just lost money, no tax relief. And wouldn't it be nice to be enjoying a holiday in a charming cottage such as this? And those of us who are investing in furnished holiday lets, perhaps being let through Airbnb, are not subject to Section 24. Section 24 only applies to long-term lets and HMOs, does not apply to furnished holiday lets. Please be very careful with VAT. There is a compulsory threshold above which you must register for VAT at £85,000. I have had 3 clients in the last year, all of whom are monitoring their turnover very carefully on the figures being paid to them by the marketing companies, which of course are net of the marketing company's charge. When you add back the marketing company's charge, 3 of them had gone over the VAT threshold, and suddenly they owed HMRC 1/6 of their turnover. So VAT is one to watch out for. Much better tax treatment for furnished holiday lets, much more flexible profit sharing arrangements, better treatment for capital gains as well. Now, there are lots of reliefs. If I dispose of a furnished holiday let, there are many more reliefs available for my capital gain than there are for a single let or an HMO. I can get gift relief, rollover relief, the snappily titled business asset disposal relief, all of those. And that sometimes causes confusion because people believe that just because furnished holiday lets get better capital gains tax treatment, they're going to get better inheritance tax treatment, and that's not the case. So from an inheritance tax point of view, no property investment short of a hotel is going to qualify for business relief, which means your families are paying 40% inheritance tax on the property portfolio that you hand down, which is why we spend a lot of time helping clients get into limited companies that can be structured to be efficient for inheritance tax. Now, let's think about what the future holds. I predict we're going to have a pre-election budget, and those of us with as much grey hair and as little hair as I have can guess there's going to be a tax cut, because we've never seen that trick before, have we? We're then going to have an election, and who knows what's going to happen there. Don't get involved in politics, it's far too difficult and complicated for me. And after the election, there'll be a new government of whatever hue. He will have a 5-year mandate, and they can afford to be very unpopular in the early years. So I predict the post-election budget is not going to be pleasant. But let's try and make some more predictions for you. And those who've seen me speak before can probably guess my predictions because they're the same ones most times. It seems illogical to me that capital gains tax has a maximum rate of 28% when income tax has a maximum rate of 45%. So if anybody has assets they wish to dispose of, they should get on with some planning, because it's quite possible capital gains tax could go up quite dramatically. Inheritance tax, there's rumours that they're going to cancel inheritance tax. Who knows? It only fetches in £6 billion a year after all. So who knows what's going to happen now? I suspect they won't. But the bit I'm worried about is the interaction between capital gains and inheritance tax. Currently, if I've owned property for a long time that's gone up in value, if I sell it, I pay capital gains tax. If instead I die, go to heaven, I hope, and my family inherit, they only pay inheritance tax. They don't have to pay capital gains tax as well. I wonder what's going to happen in the future. So that's something else I would like you to be thinking about as a possible risk. If this all seems too difficult to manage on your own, and you might want to get some professional help, then we're a very friendly firm. We're just up the road in Shrewsbury, and we're not at all scary, and we can hopefully explain things in simple terms and not usually in quite such a rush as this evening. Lots of experience, saving clients lots of tax for really quite incredibly affordable fees. And if anybody, having seen me speak, would like to know my contact details, they are on the screen currently. And thank you very much for your attention.